If you've watched the earlier videos in this series, this is where we change altitude. Those videos were about individual instruments, price to earnings ratio, ROE, free cash flow, weighted average cost of capital, necessary tools. This masterclass is about what happens when those tools start agreeing with each other. When multiple reasonable numbers line up, when confidence compounds, when doubt disappears. This is the most dangerous moment in investing, in my view. The goal here is not to abandon or dismiss the analysis. That would be rather childish. The goal is to recover judgment, to understand where numbers inform reality and where they merely anesthetize it. Over the course of this masterclass, we are going to do something slightly unfashionable. We are going to slow down. We are going to interrogate assumptions rather than calibrate outputs. We are going to treat valuation models the way a good barrister treats evidence, not as truth, but as something that needs cross-examination. Because markets don't punish ignorance nearly as ruthlessly as they punish misplaced certainty. And certainty is exactly what clean numbers are designed to give you. Before we touch a single ratio, we need to answer a more basic question. Why do numbers make us feel safe in the first place? That's not finance, that's psychology. And it's where the real audit begins, the seduction of numbers. Before we talk about ratios, models, or valuation, we need to understand something more fundamental here. I repeat, human beings are not wired for uncertainty. We evolved to survive, not to forget cash flows 20 years into the future. Ambiguity makes us anxious. Probability frustrates us. Open-ended questions feel unresolved. Numbers, by contrast, feel comforting. They have edges, they have boundaries. They give the impression that something has been pinned down. This is why measurement has always carried authority. In science, in medicine, in law, and in finance. If something can be measured, it feels knowable. If it's knowable, it feels controllable. Behavioral finance has a name for this instinct. It's called the illusion of control. The tendency to believe that because we can quantify something, we can manage its outcome. But quantification is not mastery. It's often just organization, in my view. Daniel Kahneman spent much of his career studying how experts make decisions under uncertainty. One of his most unsettling conclusions was this. Experts are often more overconfident than novices, not because they know less, but because they know just enough to build coherent stories. Finance is a perfect environment for this. We take a complex adaptive system and translate it into a few ratios, a set of assumptions, a discounted cash flow. And suddenly, uncertainty feels domesticated. The spreadsheet behaves. There's a useful analogy here. Think about a map. A map is an extraordinary invention. It compresses reality into something navigable. But no one confuses a map with the terrain, except in markets. In investing, we routinely mistake the model for the world. We forget that every ratio is just a simplification. Every forecast is conditional. Every discount rate is a belief dressed up as mathematics. George Box, the statistician, once remarked that all models are wrong, but some are useful. What often gets left out is the second half of that thought. Models are useful only if you remember they are wrong. The danger begins when you forget. This is where precision becomes seductive. A valuation of £42.37 feels more serious than 40 to 45. The extra decimals imply care, but they also disguise fragility in my view. They suggest a level of certainty the underlying assumptions simply don't support. There's a courtroom analogy that's worth using here. In law, evidence is not accepted because it is detailed. It is accepted because it is reliable. A beautifully presented piece of evidence that rests on a shaky assumption is still weak, no matter how polished it looks. Financial models are the same. A valuation doesn't become robust because it's complex. It becomes robust when it survives skepticism. This is why experienced investors tend to speak differently. They use ranges, not point estimates. They talk about scenarios, not forecasts. They are less interested in what will happen and more interested in what could go wrong. George Soros once described markets as reflexive. Prices influence fundamentals, and fundamentals influence prices. That feedback loop breaks the neat cause and effect logic that models rely on. Yet, most spreadsheets quietly assume reflexivity doesn't exist. So, when numbers feel reassuring, it's worth pausing, not to reject them, but to ask why they are making you feel calm. Is it because risk has been reduced or because uncertainty has been hidden? This distinction matters a lot because markets don't collapse when numbers are wrong. They collapse when confidence is misplaced. Now that we understand why numbers seduce us, we can move to the next step. How different metrics, each reasonable on their own, can quietly reinforce the same false story when used together. That's where confidence compounds, and that's where things get dangerous. There is a moment in the analysis that feels deeply reassuring. It's the moment when different numbers start agreeing with each other. The price to earnings ratio looks reasonable, return on equity is strong, free cash flow is healthy, the discount rate feels conservative, everything lines up. This is the moment when confidence hardens into conviction. But this is also the moment when investors are most vulnerable because agreement doesn't necessarily mean truth. It often means shared assumptions. Think about how this works. A company benefits from a favorable environment. Low interest rates, strong demand, cheap credit. That environment lifts earnings. Higher earnings reduce the price to earnings ratio. At the same time, cheap debt encourages leverage. Leverage boosts return on equity, as I've explained previously. And because interest costs are low, free cash flow looks robust. Now something subtle happens. Each metric appears to confirm the others. The business looks cheap on earnings, efficient on capital, cash generative, and fairly valued when discounted. But what's really happening is that the same underlying condition is flattering every input. This is confirmation masquerading as diversification. You think you are triangulating truth. In reality, you are measuring the same thing from multiple angles. There's a concept in statistics worth mentioning here. Correlation is not diversification. Measuring something 5 times doesn't make it more reliable. It just makes it more confident. This is why bad investments often look best just before they fail. Not because the analysis was sloppy, but because the environment was doing the analytical work for you. This pattern repeats throughout history. Boom periods produce beautiful numbers. Busts reveal how little independent information those numbers contained. There's an analogy from medicine that fits perfectly here. If 5 different diagnostic tests all rely on the same underlying biomarker, agreement doesn't improve diagnosis, it amplifies the same error. In investing, many ratios share the same hidden dependencies. This is where professional skepticism kicks in. When metrics agree too easily, professionals become suspicious. They ask, what assumption is common to all of these? What happens if that assumption breaks? Where is the risk being double counted as confirmation? Because agreement feels like safety, but it can just as easily be collective blindness. This is why institutional investors spend so much time stress testing, not because they distrust numbers, but because they distrust harmony. When everything looks neat, they start pulling threads, and this brings us to the next escalation. The moment when confirmation becomes embedded permanently, when the assumptions are no longer questioned, when they are locked into a model. That's where the precision fallacy becomes structural. And that's where we go next. Up to this point, we have talked about numbers, ratios, and confidence in the abstract. Now we need to do something more uncomfortable. We need to put the model on the stand. A valuation model has enormous persuasive power, not because it predicts the future, but because it looks like it understands it. Rows, columns, assumptions neatly organized, outputs that arrive with quiet authority. The model doesn't shout, it doesn't argue, it simply delivers a result. This is why models are rarely challenged once they are built. They feel like machinery. And we tend to trust machines, don't we? But here's the crucial thing to understand. A model is not an independent judge. It's a witness. And like any witness, it must be cross-examined. Let's imagine a generic valuation model. No company names, no stock tips, no market calls, just a clean professional spreadsheet. Projected cash flows, a discount rate, a terminal value. Everything looks reasonable. Nothing jumps out as aggressive. This is where most people stop. The model balances. The valuation looks sensible. Confidence sets in. But this is precisely the moment where a professional leans forward. The first question is not what's the value. It's where is the weight? Where is the most of the valuation actually coming from? In many models, the answer is uncomfortable. A large proportion of the value sits in the terminal value, often the majority. That means today's valuation depends heavily on assumptions about the cash flow far into the future. Years we can't see, markets we can't predict, conditions we can't control. And yet, those assumptions are treated with the same seriousness as next year's revenue. They are given decimal points, they are discounted with confidence, they are presented as if distance reduces uncertainty. It does the opposite actually. This is where the precision fallacy becomes visible. We use every precise mathematics to describe something we understand very poorly. There is an engineering analogy worth using here. In structural engineering, tolerances are explicit. Engineers know which parts of the bridge are load-bearing. They know where failure would be catastrophic. They don't just admire the design, they stress test it. In valuation, we often admire the design, but we forget to ask where failure would occur. This is why sensitivity analysis matters more than point estimates. Not because it gives you a better answer, but because it shows you how fragile the answer is. When you move the discount rate slightly and value swings dramatically, the model is telling you something important, not about the company, but about your confidence. Professionals don't find this unsettling. They expect it. They understand that valuation is not about precision. It's about exposure. Exposure to assumptions, exposure to regimes, exposure to being wrong. This is why good investors are often unimpressed by elegant models. They are more interested in ugly questions. What happens if growth slows earlier? What happens if margins mean revert? What happens if capital becomes scarce? The model doesn't answer any questions for you. It waits for you to ask them. And this is the key point. A model never creates confidence. It only reflects it. If you feel certain after building a model, it's not because uncertainty disappeared. It's because the model hid it well. This is why the most dangerous phrase in valuation is not "this looks cheap." It's "the model says." Because models do not decide, people do. At this point, the pattern should be unmistakable. Ratios compress complexity. Agreement reinforces belief. Models familiarize assumptions. Confidence compounds. Now we need to step back and ask the most important question of all. If numbers, ratios, and models all create false confidence when misused, how do professionals actually think? Not calculate, just think. How do they actually think about it? That's where we go next. Professional investors don't win by eliminating uncertainty. They win by respecting it. This is one of the biggest differences between how investing is taught and how it is practiced. Most education focuses on answers. Professionals focus on exposure. Instead of asking, what is the value? They ask, what am I exposed to if I am wrong? Wrong about growth, wrong about margins, wrong about rates, wrong about competition. Because those are the errors that actually hurt. And this is exactly why experienced investors sound different when they talk. They speak in probabilities, not certainties. They say things like, if this happens under this scenario, we are comfortable with this risk because. That language is not indecision, it's discipline. There's a quote often attributed to Charlie Munger that captures this mindset perfectly. He once said that the first rule of compounding is never to interrupt it unnecessarily. What's implied there is something deeper. Survival comes first. Professional investing is not about maximizing upside, it's about avoiding ruin. Because if you avoid ruin, time does the rest for you. This is why institutional thinking is asymmetrical. Upside is welcome, downside is interrogated, returns are celebrated, losses are analyzed. You see this clearly in how professionals use models. They don't ask models to tell them the future. They ask models to show them where the future could break. There's a useful analogy from aviation. Pilots don't rely on instruments because they expect perfect conditions. They rely on them because they expect conditions to deteriorate. The instruments are there to reveal risk, not to remove it. The same is true in investing. A good model doesn't make you confident, it makes you alert. And this is exactly why institutional investors care so much about stress. Not stress in the emotional sense, stress in the structural sense. What happens if liquidity dries up? What happens if refinancing is not available? What happens if confidence evaporates? These are not exotic scenarios. These are recurring features of the market. The only question is timing. This is also why professionals are skeptical of elegant narratives. When a story sounds too coherent, too complete, too reassuring, they slow down, because reality rarely cooperates with neat explanations. John Maynard Keynes once observed that markets can remain irrational longer than you can remain solvent. That line is often misunderstood. It's not an argument against analysis, it's a warning against overconfidence. This brings us to the final part of the masterclass. If false confidence is the real danger, how do you recognize it early before it becomes expensive? So, how do you spot false confidence before it hurts? Because at this point, we have talked about confidence, where it comes from, why it feels good, why it's dangerous. Now we need to make this actionable, because skepticism without structure is just cynicism. What professionals develop over time is not better prediction, it's better filters, ways of recognizing when confidence is being manufactured rather than earned. So here is a skeptic's checklist, not a formula, not a scoring system, a set of questions that quietly cut through false certainty. First question, where is the most of the value coming from? If the majority of your valuation sits far into the future, you are not valuing the business. You are valuing a set of assumptions. That doesn't make the valuation wrong though. It makes it fragile. Professionals don't panic about this. They simply acknowledge it. They ask how much faith is being placed into things that can't be verified. Second question, which assumptions matter the most? Not all assumptions are equal. Some barely move the outcome. Others change everything. Growth rates, discount rates, margins, capital intensity. If small changes produce large swings, the model is telling you something very important, as I previously explained. It's telling you where humility is required. Third question, are multiple metrics really independent? When price to earnings ratio, ROE, cash flow, and valuation all point in the same direction, ask why. Are they capturing different realities, or are they all responding to the same environment? Low rates, cheap capital, favorable cycles. Agreement can be a warning sign, not reassurance. Fourth question, what has to stay true for this to work? Every investment has conditions, right? Sometimes they are explicit, often they are implicit. Stable funding, continued growth, access to capital, benign competition. Write them down. If you can't articulate them, you don't understand the risk. Fifth question, what happens in stress? Not catastrophe, stress. Slower growth, higher rates, tighter credit. Professional investors are not obsessed with worst cases. They are obsessed with survivability, because businesses don't fail in textbooks. They fail in transitions. Sixth question, does the analysis genuinely reduce uncertainty or just relocates it? This is the hardest one, because analysis often feels like progress, but sometimes it just moves uncertainty into places you stop looking. Terminal values, discount rates, long-term assumptions. If you feel calmer without understanding why, pause. That calm may be artificial. These questions don't give you answers, they give you posture. They turn you from a consumer of numbers into an examiner of them. This is the real professional edge, not knowing more, but doubting better. The purpose of this analysis is not to feel smart, it is to be less wrong. Ratios are not lies, models are not deceptions, but they are incomplete, and when treated as truths, they create confidence that has not been earned. The investors who survive long enough to matter all learn the same lesson. Markets don't reward certainty, they punish it. And if this masterclass has done its job, you won't walk away with a new formula. You will walk away with a different reflex, a pause, a question, a willingness to interrogate comfort. And that reflex matters far more than any metric. If this way of thinking resonates, judgment over shortcuts, skepticism over certainty, then this channel is probably for you. Subscribe if you want to keep building that lens, and I'll see you in the next video. All the best.